Okay, let's unpack this. Have you ever caught yourself making the same money mistakes, like over and over, even though you know better? You understand saving is important, investing wisely, all that stuff. But then you kind of do the exact opposite. It's a frustrating loop, right? And, well, you're definitely not alone in feeling that. Maybe you're looking at a crypto chart that's just, yeah, a tangled mess. Or wondering why you keep buying a stock right before it dips. Happens. Today, we're really diving deep into why this happens. And, spoiler alert, it's often not even your fault. Honest. We're going to try and demystify some pretty complex market concepts, things like crypto volatility, options trading, show you how maybe you can turn them from, intimidating forces into powerful tools. We'll also shine a light on, well, master financial deception, help you protect your finances, and, believe it or not, even uncover the surprising value hiding in that quirky $2 bill you might have stashed away somewhere. Our mission, like always, is to pull out the most important nuggets of knowledge, key insights from our sources, basically give you a shortcut to being genuinely well-informed. So it's pretty clear our internal wiring, our brains, play a huge role in the financial choices we make. And this next finding from our sources, it really opens up a new perspective. It seems there's this deep, almost primal reason behind a lot of financial struggle.
Oh, it's absolutely wild when you look at it. There's this neuroscientist, Tessa Santarpia, and her research basically shows your brain has been, let's say, sabotaging your bank account for something like 50,000 years. It's not your rational mind calling the shots most of the time. It's your nervous system.
Wow, 50,000 years?
Yeah. So that old advice you hear, remove emotions from money decisions. Our sources suggest it's kind of nonsense, totally out of sync with how our brains actually work. You simply can't switch off emotion like that. Your nervous system, it doesn't really know the difference between a saber-toothed tiger back then and a big credit card bill today.
Okay, that makes sense. Same panic feeling.
Exactly. Both can trigger that same primal fight or flight response. And this also explains why instant gratification, that impulsive purchase feels so compelling. Our ancestors, they needed those short-term rewards for immediate survival. And that ancient wiring, it still pulls at us today, often keeping us from building that long-term wealth.
So it's not just about willpower then. This is something much more ingrained.
Precisely. Yeah, way more ingrained. People talk about scarcity as a mindset, but Santarpia, she clarifies it's more like a survival mode, hardwired into your body. If you grew up with financial stress, maybe money worries were common, your nervous system can literally wire itself to see wealth, or even just having enough money, as unsafe.
Unsafe? How so?
Well, it explains why you might feel anxiety checking your bank balance, even when it's actually healthy, or why sometimes people self-sabotage just as things start going really well financially. Your body is basically screaming danger. Even when logic says everything is totally fine, it's like your brain still thinks you're in some zero-sum survival game. I still catch myself sometimes feeling that little knot in my stomach checking balances, even when I know things are okay. That's that ancestral wiring right there.
That sounds incredibly powerful, and honestly, a bit disheartening if we're up against 50,000 years of evolution. But here's the good news, right? Our sources definitely confirm your brain can be rewired. Neuroplasticity. It means change is possible, really at any age. And Tessa Santarpia suggests it only takes about 8 weeks, maybe, to start building those new neural pathways for better money habits.
Yeah, and her favorite tool for doing this is brilliantly simple. It's called catch and replace.
Okay.
The basic idea is just to observe a negative financial thought, like, say, I'm terrible with money, and then consciously, deliberately substitute it with an empowering affirmation, something like, I'm learning to build wealth, or maybe I'm excited about my financial future.
Catch and replace. Okay.
It's not about being perfect overnight. Consistency is the key. Over time, that abundance thinking, it starts to become more automatic. And this also helps explain why traditional money advice, budgets, spreadsheets often fall short for people. They're good tools, but
They don't address the underlying feeling.
exactly. They're trying to solve what feels like a nervous system problem, that unsafe feeling, with a math solution. If your body doesn't feel safe with wealth, you'll subconsciously find ways to push it away. Your money problems often aren't just math problems, they're nervous system problems. And the really empowering truth here is you absolutely can rewire them.
That's a really crucial distinction. Okay, but for someone who's been telling themselves, I'm terrible with money for maybe decades, is just catching and replacing truly enough? Or are there deeper steps needed for such a fundamental shift?
That's a great question. Yeah, catch and replace is foundational, definitely. But you're right, it's often the entry point. The deeper step, maybe, is to consistently act as if that new belief is true, even in small ways.
Okay, like what?
So If you're telling yourself, I'm learning to build wealth, then maybe dedicate just 5 minutes to learning about a simple investment. Or track your expenses for a day, but without judgment. These small, consistent actions, they signal to your nervous system that these wealth-building activities are actually safe, maybe even enjoyable. It helps reinforce those new neural pathways.
Ah, I see.
It's about combining the mental shift with tangible, small steps, not overwhelming yourself.
Fascinating. Okay, so it's clear our internal wiring plays this huge role. But sometimes it's not just our brain playing tricks. The market itself can feel like a total labyrinth. Let's pivot now to navigating that wild world of crypto and market volatility, especially for something like options trading. For those who might be less familiar, options trading basically means buying the right but not the obligation that's key to buy or sell an asset at a set price later on. And the cost of that right, the option premium, is heavily influenced by how much the market thinks that asset's price is going to swing around. That's where volatility comes in. And you really don't need a math degree to get this. It can actually be a trader's best friend if you know how to play it.
Indeed. Yeah, while long-term investors often just, ride out the waves of volatility, day traders really need to pay close attention to it. Volatility, specifically what's called implied volatility or IV, it's a super powerful tool once you kind of understand it. When I first started with options, IV seemed incredibly complex, but let's simplify it with two key metrics our sources highlight: IV rank and 4 percentile. So think of IV rank as like a thermometer for market heat. It tells you how hot today's volatility is compared to its own range over the past year.
Its own past range, got it.
Right. So if it's at, say, 80%, volatility is blazing, meaning options premiums are generally fat, really high. This makes selling options, like writing puts or calls, potentially very rewarding. But if it's down at 10%, things are icy, premiums are cheap. So buying options actually costs less.
Makes sense. Hot means expensive, cold means cheap.
Kinda, yeah. Then there's IV percentile. Think of this as your class rank among all the volatility levels over the past year. So if a stock has a 70% IV percentile, it means that 70% of the trading days in the last year had lower volatility than today.
Oh, okay.
This shows you how unusual today's price swings are, historically speaking. It gives you crucial context for gauging risk.
Okay, so IV rank tells us how hot it is right now relative to its own yearly extremes, high and low. And IV percentile tells us how often it's been this hot or hotter in the past year. How do these two work together then? It sounds like you really need both pieces of info.
Exactly. You absolutely need both. They give you a much fuller picture. Think of it like this. IV rank shows you the current wave height in the ocean. Big number, big waves right now.
Okay.
But IV percentile tells you how frequently waves this big actually happen in this particular ocean, the stock or crypto. So if IV rank is, say, 80%, meaning it's near its highest level for the year, and the IV percentile is 70%, meaning 70% of days were calmer, that combination is powerful.
Right.
It tells you, okay, this isn't just high volatility for today, it's actually unusually high compared to its history. It signals a truly rare high premium environment, potentially great for selling options. Conversely, if both are really low, say 10% rank and 5% percentile, it signals a rare, low premium environment, maybe better for buying. It's your nuanced guide. Are you selling into peak excitement or buying into unusual calm?
That really clarifies it. Okay, to make this super practical for you listening, imagine a scenario where options have an IV rank of, say, 85% and an IV percentile of 90%. Like the expert said, premiums are going to be through the roof. In this environment, maybe selling a put could net you hundreds of dollars for just a short-term contract. You're capitalizing on that inflated fear or excitement premium. But flip side, IV rank of 15% and IV percentile 10%. Premiums are dirt cheap. This makes buying a call option much more affordable. You can position yourself to profit from potential price swings with less capital risk up front. So yeah, these are really concrete, actionable differences in how you'd approach the market based on these numbers.
Absolutely. The key is understanding how to use volatility wisely, not just react to it. High PV, generally meaning high rank and high percentile, suggests the market is pricing in big moves. Premiums are rich. So it's often a good time to consider selling options. Low IV suggests contracts are cheaper, maybe a better time to consider buying options if your strategy aligns. These two stats, IV rank and percentile, they really are like secret weapons for understanding market sentiment. Doesn't matter if you're trading stocks or dancing with crypto options, they help you be proactive.
Okay, so understanding our brains, understanding market volatility, those are huge. But if our own minds can trip us up, imagine what a master of deception can do.
Yeah, this deep dive wouldn't really be complete without looking at one of history's biggest financial horror stories. It really underscores the critical importance of, well, doing your homework due diligence. It's truly striking, isn't it, Bernie Madoff? The man behind the largest financial fraud in history. There's a book and film, The Wizard of Lies, a chilling account of his, $65 billion Ponzi scheme. Just staggering numbers. What's so profound, or maybe terrifying, is how his sheer charm and his seemingly impeccable reputation allowed him to just bypass all critical scrutiny for decades.
Yeah.
He was seen as a trusted Wall Street insider, pillar of the community, and that trust, it blinded even really sophisticated investors, not to mention his own family and friends. This story is just such a powerful lesson in due diligence and the critical importance of questioning anything that seems too good to be true, no matter how trusted the source appears.
That's a powerful lesson, absolutely. But here's a tough question. If Madoff could fool so many sophisticated people, what specific, maybe even counterintuitive red flags should we really be looking for? Is it just about the returns being too high, or is it something more subtle maybe, about the person or the setup?
That is the million-dollar question, isn't it? And our sources, they highlight something interesting. Often, the biggest red flags aren't just about absurdly high returns. Madoff's reported returns, they were consistently good, maybe 10–12% a year, but not outrageously high like some Ponzi schemes. That consistency actually made them seem plausible, believable.
Right. Steady wins the race, or seems to.
Exactly. The real red flag often lies in the lack of transparency, or sometimes this feeling of exclusivity. Madoff operated with a total black box approach. He refused to disclose his actual trading strategy, citing, proprietary secrets, and he cultivated this aura, only taking money from exclusive clients, making people feel privileged to get in.
Ah, the velvet rope strategy.
Pretty much. So look for complexity without clarity, and especially be wary of any investment where you cannot independently verify your holdings or directly access your funds through a well-known, regulated third-party institution like a major brokerage firm. Your money should never reside solely with one individual or some opaque private entity you can't check up on easily.
That makes a lot of sense. Crucial advice. So what does this all mean for you, listening right now? How can you avoid falling prey to a wizard like Madoff and really protect your hard-earned money?
It really means taking an active, informed role. You have to. The action step here is clear. Don't blindly follow any guru or investment tip, no matter how charismatic or well-connected they seem. Always ask probing questions. Look for those red flags we mentioned: secrecy, exclusivity, lack of independent verification. And most importantly, ensure your money is held in an account you can actually see, verify, and access yourself through a recognized, regulated custodian. Don't just take someone's word for it or look at fancy statements they generate. My sort of hot take on this: the Wizard of Lies proves that sometimes the smartest people, the most sophisticated investors, can actually be the easiest to fool when their own greed, or maybe just their desire for exclusivity, gets in the way.
Right.
It's a stark reminder that sometimes the biggest risk isn't even the market itself. It's the person managing your money, your financial future. Ultimately, it's your responsibility to protect.
It's really sobering stuff. Okay, so beyond the brain science and the market mechanics and these cautionary tales, our sources also gave us this fantastic collection of other intriguing nuggets, little bits and pieces that can help empower your wealth journey. Let's dive into some quick-fire insights now from various corners of our research, kind of like a wealth potpourri.
Absolutely. Okay, first up, let's talk about patience. Our sources consistently highlight this as maybe the most underrated wealth strategy out there. For new investors especially, the key insight seems to be: resist that urge to jump into complex trades right away. It's tempting, but maybe just start by observing. Observe volatility, try to understand market rhythms, and let small, consistent investments compound over time. The biggest gains often come from that steady, almost boring commitment, not sudden sprints.
Slow and steady. Got it. What else?
Okay, next. For anyone using social media for business, the most actionable insight we found for actually tracking your earnings is to shift focus away from vanity metrics, like likes or follower count. Instead, focus on direct conversion tracking. Use unique affiliate links for different posts. Track specific downloads tied to campaigns. Use distinct discount codes for different pieces of content.
So you know what's actually working.
Exactly. This pinpoints precisely which online efforts are truly driving revenue. That lets you optimize your strategy beyond just getting engagement. Make the connection to the bottom line.
Smart. Okay, next.
Then there's the classic debate: index funds versus individual stocks. Our sources kind of reinforced a common finding. For the vast majority of long-term investors, index funds statistically tend to outperform picking individual stocks over time. Why? Mainly superior diversification and lower fees. So the critical insight is, unless you're maybe a professional investor with deep research capabilities or you have a super high conviction thesis on a specific company,
Which most of us don't.
right, defaulting to broad market index funds is generally the smarter, lower stress path for wealth accumulation for most people.
Good reminder. Keep it simple.
Okay, for the entrepreneurs listening, there's a powerful insight into how to turn your brain into a business. It's not just about vaguely sharing knowledge. It's about identifying a specific, acute problem that your ideal customer faces, and then packaging your expertise as a tangible, transformative solution to that problem. Think structured courses that deliver a clear outcome, or personalized coaching to overcome specific hurdles, actionable frameworks that simplify complex tasks. Your brain becomes a business when you solve a valuable problem people will pay to fix.
Solve a problem. Love that. What about real estate? Airbnb.
Right. For those eyeing the Airbnb market in, say, 2025, the honest truth from our sources is profitability isn't what it once was for just any old generic property. There's more competition, more regulations. The key insight for serious returns now seems to lie in hyperlocal market research, really knowing your area, strictly adhering to new regulations, that's huge now, and offering unique or luxury experiences that stand out.
So specialization is key.
Yeah, generic listings face stiff competition and often diminishing returns. Success hinges more on niche properties, exceptional service, or strategic locations that can command premium rates. Often this means higher upfront investment too. Diversification within real estate might also be becoming more crucial.
Makes sense. Okay, one more.
And finally, just a fun, quick fact about that $2 bill. Our sources confirm, yes, they are absolutely legal tender. They just circulate very slowly, which is why they seem rare. Don't toss them if you get one. They're apparently a fantastic conversation starter. And surprisingly, they can just make using cash a little more interesting. So use them confidently. They're perfectly good money.
Huh. Good to know. All right, so quite a journey today. We've unraveled maybe why your own brain might be playing tricks on your bank account. We've demystified market heat, that Ivy stuff, for options trading. Learned a truly powerful, if sobering, lesson from history's biggest con artist. And explored various actionable paths to wealth, from patience to problem solving to, well, $2 bills. Remember, the journey to wealth, it seems, is less about being perfect and much more about being persistent, and about understanding these hidden forces at play both inside your own mind and out there in the markets.
That's exactly right.
Yeah.
Keep showing up, keep learning, and truly don't ever be afraid to ask those dumb questions because honestly, they're usually the smartest ones. They lead to the deepest understanding. Ultimately, wealth isn't just about the numbers in your bank account, is it? It's also about making your brain, your nervous system, feel safe enough to actually let you keep it and grow it.
So well put. Okay, considering everything we've uncovered today, here's something to think about. What's one single assumption you had about your money, or maybe about the markets, that you're now going to approach differently? Just mull that over. And then maybe take one small action this week to explore that new perspective. See what happens.